Joining our closing bell exchange today to discuss more are Eugene Profit from Profit Investments, Jonathan Corpina from Meridian Equity Partners, and Rick Santelli at the CME in Chicago. Good afternoon to you all. Jonathan, if I start with you, I mean, encouraging response to the sort of Fed-inspired sell-off yesterday. What do you make of the driving factors today?
You know, historically, when you look at Fed announcements and interest rate hikes, there's a lot of anticipation leading up to it, and then the euphoria is over very quickly. We saw the volatility yesterday throughout the Fed speech and afterwards, and today it bounces right back up again. Continual pattern that we've seen, that the market always rebounds and always recovers after any significant news that we've heard over the last 6 months to 12 months. There's been a lot of things on our calendars this month. We had the big S&P Russell reweight last week. We had the Fed yesterday. The testimony coming out of Washington today wasn't expected, but it's something that everyone has been focusing on. We had the president speak yesterday, so a lot occurring here in this period of time. And let's also not forget, end of the month, end of the quarter. This quarter we're up 7.5%. No need for window dressing that we normally see, but after saying that, it has been a profitable quarter, best one we've seen since 2013.
Rick, I'm wondering what you make of the reaction to the Fed and the fact that we're seeing yields move lower and the dollar move higher. Is that sending different signals about the path of rates?
Well, if it was diverging in a meaningful way, I would say yes. The pop in the dollar doesn't surprise me at all. As a matter of fact, considering the global fundamentals, I would think the dollar should be much stronger. But we all know trade logistics, lots of people having the same position or at least same position location sometimes complicates these things. But in terms of interest rates, I think it's actually been holding in rather well. Yes, we didn't get that close testing of 311. We got up there intraday earlier in the week, not even yesterday before the announcement or after, and they have come off, as you said. But here we hover at 305 and a 10, 317 and a 30, 283 and a 2. They haven't really given back much. I guess I'd look at it this way. If I was trading treasuries right now, I would try to sell the dips and look for a test of 311. If we start to dip below 3%, especially tomorrow, I would think that would be significant. But truly, it doesn't surprise me at all that interest rates gave a little back, but they didn't give a lot back, and that really is the issue.
Eugene, we were talking earlier in the show about the way that Apple and Amazon are dragging markets higher today. You prefer Microsoft, though?
I do, and actually it's because of what you see in Amazon. Microsoft has done a really good job of adjusting into the cloud environment, and they're starting to get adoption to their Azure platform. They have basically 80% growth in that area, although Amazon's the leader at 49%. So I think that Microsoft has really transitioned itself from being a big old bellwether tech stock that no one really wanted to own to really go after the service business where they have 18% margins. And I think you could own either one, but Microsoft is at a much lower valuation.